Julie Ziemelis, 365 Hawaii, 365 Hawaii Group, Keller Williams, and here I am today with Travis Green, who is the manager of V.I.P Mortgage, and he is working with us today at this trade show that we're at, and he has an amazing amount of information and knowledge to share with you. And today he's going to talk to you guys a little bit about what's happening with the rates, and also about programs that you guys might be interested in learning about. So tell us what's the story and your whole story.
Yeah, great. Well, thanks so much. I'm excited to be here. So, so I just want to clarify, I'm one of the branch managers at V.I.P Mortgage. Yeah, we have a lot of us. Wanted to share a market update, kind of what's happening with interest rates. It's not all bad news like it was for a lot of last year. So just to kind of catch us up to where we are today, right? So 2022 saw the highest mortgage rates that we had seen in 20 years, okay? As well as the most rapid increase in rates that we had seen in 40 years, right? So rates at 20-year highs, but the run-up was faster than had happened in 40 years. And all of that is basically due to the highest inflation that we'd seen in about 40 years. So
because the Fed sucked.
Well, yeah, right? So there was a lot going on, right? So we had supply chain issues from COVID. We had the Russian invasion of Ukraine, disrupting wheat and energy prices. And so there was a lot of things kind of conspiring to make a really just unpleasant inflationary environment, right? And so we had a lot of kind of accommodative monetary policy, I'll say, with the Fed keeping rates at or near zero for a long time. And so mortgage rates prior to 2022, from 2020 into the beginning of 2022, were at historic lows, right? So that contributed to rapid acceleration in home values, right? Because affordability was greater. People were able to buy a lot more. They were able to make those kind of over-list bids.
Right.
And with our lack of inventory, that kind of was its own little fire that got going and kept going. So,
and also people were refinancing their mortgages too.
Yes. Yep,
so lots
absolutely.
of refinancing going on. And
Lots
then
of
everyone jumped into the purchase market too, right?
Yes, absolutely. So, the Fed kind of sees this happening, right? They see rapid run-up in housing prices, they see run-ups in rent, they see inflation spiking, and so they realize we left the punch bowl out too long. Time to take it away, right? So what they have been doing is they've been hiking the federal funds rate, right, at their last several meetings. And so what this does is this raises short-term borrowing costs, right? It doesn't directly influence mortgage rates, but it has an impact because it influences the bond market. So they're raising the benchmark interest rate from basically zero to, I believe right now we're at 4 to 4.25, somewhere in there. Pretty fast run up. So they're countering the fastest rise in inflation in 40 years with the fastest run up in the Fed funds rate in 40 years, right? So we don't think they're going to the places that they did in the early 80s.
Okay.
But they have been aggressive, right? So and it's working. There's signs that it's working. Inflation is moderating and coming down. And so that kind of brings us to today, right? We've had a number of successive inflation reports, CPI, Consumer Price Index, and PCE, which is consumer expenditures.
Okay.
So those over the last 6 months have showed that inflation has slowed.
Okay.
And then actually the December CPI report showed that prices actually decreased from November to December. So what this does is it adds to a body of evidence that suggests that perhaps inflation has peaked.
Yeah.
And also perhaps mortgage rates have peaked.
Okay.
Okay. So I know Lance and I were talking about this earlier, but if you look, you saw rates kind of run up all throughout 2022.
Yeah.
Kind of reach a peak October, November.
Yeah.
And then they've been coming down for 4 or 5 weeks straight.
Right.
And so broadly speaking, everybody wants to know, like, what are the rates? Where are rates right now? So October, November, we saw rates at and above 7% for a typical conventional 30-year fixed rate mortgage, right? And that means, what I mean by that is like 740 credit score, 20% down. Most people were seeing 7% or more in October, November on a 30-year fixed. Now, we are seeing, the Fed has not lowered rates, but we are seeing interest rates in the mid to low sixes.
Right.
For a lot of buyers.
Right.
Part of this is because the spread between the 10-year Treasury yield and 30-year fixed rate mortgages is greater than it normally is. So normally it's like a 10-year Treasury plus about 1.8 and that gives you an average 30-year fixed rate mortgage. Now it's the 10-year treasury yield plus about 2.8. Okay. So the thinking for a lot of people goes that once things stabilize, calm down, and we have some clarity about the future, that spread will shrink to what it normally is and bring us in line with a better, more average interest rate.
Okay.
Right now, if the spread were what it normally is historically, we'd be at about 5.5%.
Right.
As it is, we're about 6.25, 6.375 for most folks, somewhere right in there.
Okay.
So that brings us to where most people are seeing rates today.
And which are?
Low sixes.
Low sixes.
Low to mid sixes for most people.
Okay.
Again, 30-year fixed, conventional, 740 credit score, 20% down. So obviously it's been a challenging environment for buyers, right?
Right.
And a lot of people, I think, got fatigued over the last year, especially.
Well, chasing down houses and having to deal with overbidding and everything else, right?
They're getting overbid, they're kind of getting beat up. It's been very, very difficult. And then rates double, right? From January to October, interest rates doubled. And so they feel like they can't catch a break, right? So the rate spike has caused the real estate market to slow down, right? There's fewer sales, there's fewer listings, things are sitting on the market longer, and there's more price reductions on average, right? So I want to talk about like how people are taking advantage of that.
Okay.
Right? So seller concessions is really what I want to focus on. Right? So
beat those sellers.
Yeah, it's a seller concession. So a seller concession, also known as like an interested party contribution or a seller contribution, seller credit it often is called, is it's basically the seller directly contributing to the buyer's closing costs.
There we go.
Right? So closing costs are like lender fees, title and escrow fees. They can be your prepaid interest. They can be your upfront mortgage insurance. It can be property taxes and homeowners insurance, things like that. So let's say that, let's say your total closing costs are $8,000 as a buyer. Well, that's separate from your down payment, right? So what we're seeing right now is a lot of our buyers are getting the seller to agree to just credit them enough to cover some, most, or all of their closing costs.
Okay.
Where this comes into play on interest rates is with buy downs.
Yep.
Right? So you hear about people paying points, paying points on your rate or buying down your rate. So seller concessions can go towards that as well.
Okay.
Right? So I actually have a flyer here today that maybe I can share with you and you can put on YouTube maybe, but it describes the maximum amount of seller concessions per transaction, right? It's a helpful little cheat sheet for realtors.
Okay.
And so for most people, like on a conventional loan, if they're putting 10% down or less, the seller can contribute 3% of the sale price towards their closing costs.
Oh, wow.
So if you think about like an $800,000 house, that's 24 grand.
Yeah.
Right?
That's a lot.
That's a lot more than typical closing costs.
Yeah.
So what we do is, and it has to go towards closing costs.
Yeah.
Can't be down payment. So what we do is, say your closing costs $8,000, $10,000, seller's going to give you 24 grand.
Yeah.
Right? We eat that up with discount points.
Oh, there we go.
Right? So let's say you're at 6.5% with no discount points, but you can pay 2 points and be at 5.625, right? On a loan.
And that's over the course of the loan.
Yeah, permanent buy down, right? So, and if you can get the seller to pay that, and we can kind of soak up that seller concession with those discount points, it's really going to help the buyer long term, save them thousands of dollars, especially on our average loan size here.
Yeah,
right? Our home values are higher than the average for nationally. Our loan amounts are higher, so it's a really big deal. So that's one way to think about it, is a permanent buy down, right? There's a lot to consider, right? Is it worth it? How long does it take to break even? Are you going to own the house for a long time, et cetera? So we always go over that with clients. The thing that's coming more into play now is what's called a temporary buy down. Have you heard of this? Like a 2-1 buy down, or temporary buy down, or 3-2-1?
Waiting for the world to change a little bit in better days ahead.
Yeah, so this is like, this is a little bit more of like a, like I have hope for lower rates in the near future kind of thing, but I don't want an adjustable rate mortgage. Right? So let's see. I have a scenario here.
Okay.
So it is a little bit more novel than a permanent buy down.
Okay.
But it basically it uses a seller concession to temporarily buy down the interest rate.
Okay.
And so let's say your starting interest rate is 6.5%.
Like it is today.
Right. So as of today, let's say it's 6.5%. So on a temporary buy down, what we're going to do is, and there's different ways to do this, but on a 2-1, we're going to say, okay, what is the payment at 6.5%? And we're going to figure that out. And then we're going to say, what is the payment at 4.5%? Because that's the 2. It's 2 points below the 6.5.
Right.
So we're going to say, what's the payment at 4.5%? And we're going to take that payment difference, multiply it by 12, and set that aside, right? So that's part of our seller concession. It's the difference between 4.5% and 6.5% on that monthly payment, the P&I. And then we're going to say, what's the difference between the payment at 5.5% and the payment at 6.5%?
Okay.
Subtract that, multiply by 12 payments in a year, and we get those two amounts and we add them together, and those are our buy down funds.
Okay.
So literally your rate is still 6.5%, but for the first year, you're making a payment as if it's 4.5%, and then your mortgage company is literally paying the difference with those set aside seller funds. The second year, your payment is as if it's 5.5%. Mortgage lender is paying the difference with those set aside seller funds. The cool thing about a temporary buy down is if you refinance before all those seller funds are used, the unused funds get applied to your principal balance.
Oh, that's nice.
Right?
Okay.
So not the case on a permanent buy down, right? You just kind of, it's gone.
It's gone.
Right? But and there's different ways to do it. There's a 3-2-1, there's a 2-1. And so it depends on the lender and the investor.
Yeah.
But we can really kind of customize that for a client based on the situation.
Okay, so let's say that I'm wanting to buy a house.
Yes.
And I come to you first.
Yes.
To say, okay, I need money before I buy a house, right?
Yes.
And you're telling me all about this stuff.
Yes.
Now I want to go find a house.
Yes.
I have to talk to somebody who's selling their house who understands this so that they'll give me the money. So we're talking about a realtor that understands this to tell their seller about how to get this happening. How's this work?
Not entirely.
Okay.
Right? So it can, basically they have to be familiar with the seller concession.
Okay.
That's kind of it, right? So if you get $15,000 in seller concession and you only need $8,500 for your temporary buy down, you can just set it up that way. And then what's not used for the temporary buy down can go to the rest of the closing costs.
Okay.
The seller doesn't have to grasp the concept of a temporary buy down necessarily.
Okay.
Although I think awareness is rising. I've had calls from listing agents saying, how do I market my seller concession to save people money on their payment? Right? And so I don't like to get too into the weeds in those phone conversations because I don't know that that's helpful. But I think the idea of the seller concession, and especially those funds being used to buy down the interest rate, whether it's permanent or temporary, I think that's kind of gaining more traction with sellers and listing agents.
Well, and also I think that it was pitched a couple of months ago before this really is, I mean, we talked about this, the market update just, right before this. Home prices are coming down.
Yes.
There's like a 3.5-4% decrease in home prices lately. So basically, instead of having sellers have to give out and say, I'm going to drop my home price by 3 or 4%, they can work with buyers to do this instead of just dropping their price and losing the money, where they're actually helping a buyer being able to come in to buy their home. And then that way it's kind of a win-win for both of them, right?
100%. Yeah. And so kind of an example I like to think about is, so if we think about an $850,000 house, right? Let's just talk in terms of like 1%, like a 1% either reduction in price or seller concession, okay? So if you get the seller to reduce the price by 1%, that's an $8,500 reduction in price, right? So a 10% down on a 30-year fixed conventional and a rate of 6.5%, the principal and interest, so not including taxes and insurance, but the principal and interest would be $4,787 a month.
Okay.
If, however, you got the seller to sell you the house at $850 list price, and contribute 1% towards your closing costs, you could take that 1% and apply it as a discount point and get your rate to 6%. Right?
Yeah.
So you'd have a slightly higher loan amount, same 10% down and everything, but your principal and interest would be $4,586 as opposed to $4,787.
Okay.
So same net to the seller, right? Big difference to the buyer.
Right. Yeah.
Almost $200 a month.
Which pays for your heating, your lighting, and your utility bills.
Yeah. So that's the thing I really like to go through with my buyers when we're talking about this. I like to have this conversation before they structure an offer with their agent, and obviously get the buy-in from the buyer's agent. But to say, hey, I know you want to discount, you want to win, you want to get something, right? You don't want to just give them exactly what they're asking for.
Right.
How about instead of asking for this much off the price, we ask for this much in seller concession,
Right,
because
right.
it's the same net to the seller,
Yeah.
massive difference to the buyer.
Right, right. And also the seller might actually feel better about this than being beaten down on their price.
Right.
Right. And
right.
so again, if people understand this whole experience, it totally works out for both sides.
Yeah. Not to mention, you're not going to anger your neighbors as much, right?
Yeah.
That want their home values to
No, that's right
reflect
too.
higher
When
sale
you drop the
prices.
price down like 10% or whatever, then you're right. It affects everybody around you.
As soon as that house closes, it's the new best comp in that neighborhood, right?
Right.
So if you can hold your price a little bit higher as a seller, that's a better thing for your neighbors who might want to sell in the future.
That's,
right?
you
So
know,
just another little positive spin on it when you're calling that listing agent to introduce that offer.
There you go. In fact, if there's anybody who's watching this who are actually thinking about selling their homes, this is a good thing to have a conversation with your realtor. That if someone comes in with trying to come down with a lower offer, that you say, let's do this instead.
Yeah.
Right?
And I always encourage sellers, or rather the listing agent, to call the buyer's lender, right?
Yeah.
Call that lender and interview them. Ask them about things like this. Do you have a buy down program? Are we going to exceed the maximum seller concession? In addition to is this buyer pre-approved? Are you certain they can close? What's the timeline? Things like that. How long do appraisals take? A good lender should know all those things. But this is a good one to bring up with the buyer's lender.
Okay.
And if you're a buyer and you're shopping around, do some research for sure, but write these questions down, whether you're working with me or somebody else. Talk to your lender about these things, right? Make sure that you understand what your options are, and have your lender go into detail about the pros and cons of each, right?
Yeah, right. And understanding the numbers, so you can. And it sounds like, in general, this isn't like some special program.
No.
I mean, this is happening all over the country right now.
Yes.
A lot of people are using this opportunity to say, how can we make it so it works for both sides, right?
Yeah. 100%.
So if people want to know about it, again, it's called the 2-to-1 buy down program.
Or temporary buy down.
Temporary buy down.
Yeah. And not every lender offers it on every scenario, right? So it's typically like a primary residence conventional loan kind of thing. There might, there's some variation on that.
Okay.
But it does depend. Not every lender will be able to do a 3-2-1 versus a 2-1, and a 3-2-1 is same premise, 6.5 starting note rate, minus 3, right? So 3.5% payment, as if it was 3.5%. First year, 4.5 next year, 5.5 next year.
There you
the
go.
idea is that let's say rates don't improve, your income improves over that time, or it's going to improve, or you're going to have some kind of windfall or something. That's another thing, is understanding exit strategy, or if you don't have one, understanding are you comfortable with this payment at that note rate for 28 or 27 of the years of this loan.
Right. In fact, when I first heard about this, I thought, oh, great, you can go in and think you're only going to have to pay, let's say, $4,000 a month, right?
Yeah.
But you have to qualify as if it was the full amount. So it's not like you all of a sudden get some kind of I get a different qualification. You have to be able to make the $6,000 payment if it goes to that point
100%.
3 years in the future, right?
Yep,
so,
absolutely.
So basically, like you said, it's kind of it's a great opportunity to wait for those rates to come down, hopefully in the next 2 years, and just refi at that point to get into that better rate. And if it doesn't, though, you still have to prepare yourself, right?
Yeah. You need to kind of understand the distinct possibility that rates won't improve to the point where it makes sense to refinance, or maybe your situation changes and you can't refinance, right? You never know what's going to happen. So, lenders need to be clear with people exploring these options that, if you don't refi, or you stay in this loan and your rate's 6.5% or 7% or whatever it is at the time, this is what your payment is, and does that work for you? Even if you qualify for it, does that work for you? Right?
Yeah.
Sometimes people qualify for more than they're comfortable paying.
Yeah. In fact, back in the day when they were doing the 1-year ARMs,
Yes.
I got stuck in that.
Oh.
And they didn't say, if you bounce out of this could turn into a 50% increase in what you're paying for your housing costs.
Big payment shocks.
Yes. And so that's happened. And so at least this way, it's not predatory.
Right.
They tell you everything up front.
It's a fixed rate mortgage.
Fixed rate mortgage, so you know exactly what's going to happen in the future.
And you're qualified by the lender on the maximum rate that it would be for the loan.
There you go.
Yeah.
Okay.
100%.
I love it.
A lot safer than the old subprime days.
Yeah, right, where we didn't know what was going to happen.
Right.
Is there any other programs that you want to discuss with these wonderful human beings out here in YouTube land?
On YouTube? There are...
Because we don't really have that many first-time homebuyer programs in Hawaii.
Right. The first-time homebuyer thing is really the ability to put 3% down on a conventional mortgage rather than the minimum 5% down.
Okay.
The good thing to know is conventional loan limits in Hawaii have increased as of January 1st to $1,089,300.
Wow.
Conventional loan.
Yeah.
For a single unit property. So,
Right.
Essentially, like, you could, in theory, buy a house for like $1,145,000-ish, I think, and put 5% down, and have a Fannie Mae 30-year fixed rate mortgage.
Yeah.
Yeah. FHA loans, however, I believe the limit increased to $517,000.
You're living in Puna.
Yeah. So Hawaii County is one MSA, Metropolitan Statistical Area, and so it all kind of gets put into one pot and averaged, right?
Okay.
So West Hawaii does not reflect that, or that doesn't reflect the reality in West Hawaii.
Yeah.
Like you said, maybe more Puna, Hilo, places like that.
Yeah.
That's a loan amount that's a little more applicable.
Yeah, but you do FHA loans.
Absolutely.
Okay, you do all the major ones. VA, FHA, USDA.
VA, absolutely. Yep.
Okay.
And
So
VA and USDA are the famous zero down ones.
right. So if you guys, Lava Zone 2. Do you?
Yes.
Okay, so Lava Zone 2, which happens if you are, like, let's say you have an FHA and you have to get a $400,000, $500,000 loan, you might find yourself in East Hawaii, and then you might find yourself on a Lava Zone 2.
So FHA will not do Lava Zone 2 anymore.
Okay.
So it's conventional, but we have, it depends on the client, but some people can do 5% down.
Okay.
Lava Zone 2, and it's a conventional mortgage.
Okay.
We do have a couple of ways to do Lava Zone 1 currently as well.
Yeah?
Yes. That's a little check with us because I would say it's a dynamic environment, right?
Okay.
So one investor,
depending on Kilauea.
yeah, and Mauna Loa, right? So one investor might be, a couple investors might be happy, and when I say investors, I mean places like PennyMac or New Res or Mr. Cooper or whatever.
I don't know any of those.
They're big mortgage servicers,
Okay.
mortgage investors.
Okay.
So let's say they're good with it now, but an eruption happens, they get spooked, and they go, we're not going to do Lava Zone 1 anymore,
So
right?
what do you pull your loan?
No. You just can't originate new ones.
Oh, okay.
Right.
Okay.
So they'll still service your loan.
Okay.
But check with your lender, right? Because most lenders want to have at least 2 investors that they can place a loan with,
Okay.
right? For safety reasons,
Yeah.
right? To cover themselves. And so if one or both of those pull out, you won't be able to get a new loan then.
Okay, so it's kind of like
with that
case by
lender.
case, deciding what's happening.
Check with your lender.
Check with your lender. And then also condo tells.
Yeah.
So what we've learned in Hawaii, you guys, if you're trying to buy a condo, especially along Alihi Drive, and you think that, hey, this would be a good opportunity for me to like get a loan on a condo, some lenders will not loan on condo tells.
Right.
And then your company.
Yes.
Does.
V.I.P mortgage.
Yes?
Yes. Yeah.
Okay.
So we have a lot of outlets, whether it's kept in-house or if it's brokered to one of our local bank partners, like First Hawaiian Bank or Bank of Hawaii. But we have really fantastic resources to be able to figure out, is this condo project approved with the bank? If not, what do you need to get it approved?
Okay.
And then what are the loan parameters, right?
Okay.
So typically a condo tel is going to have a higher minimum down payment requirement than a non-condo tel. We call it, in the industry, we call it warrantable versus non-warrantable,
Okay.
right? So condo tels are non-warrantable. And so a condo tel typically, depending on the bank, is going to be minimum 20% down.
Okay.
And that's usually if it's like a second home or primary residence.
Yep.
25% down or 30% down if it's an investment property.
Okay.
Again, depending on the lender.
Okay, and again, I want you guys to hear that one. 25 to 30% down if you're thinking about an investment piece of property.
Correct.
Because we have been getting a lot of phone
For a
calls from
condo
people
tel.
who are trying to buy investment condos here, and then they don't sometimes understand what the difference between a condo tel is versus a regular condo.
Sure.
And so they think that it's only like 20%. So
Yep.
understanding what condo complex you're looking at is important.
Yes.
And if you guys want some more information about which condo complexes are condo tels, you
Reach
have
out
a
to me.
list?
Yeah.
Yeah, you have a list
reach
of all
out to me.
those.
And if I don't know it,
Yeah.
we have fantastic reps at First Hawaiian Bank and at Bank of Hawaii that do the majority of the condo tel financing.
Okay.
And if we don't already have it approved, we check with them and they're on top of it.
Okay. So is there any other crazy issues that people need to know about in terms of financing in Hawaii?
I would really, as far as financing in Hawaii, we could have a long conversation, but I would just say for people who, I think what's happening, what I'm seeing in my personal business is that, I tap my microphone, is that, things are kind of settling down in the interest rate world. I think a lot of the people that got fatigued last year, I've noticed they're starting to reach out to me, right? Refreshing their pre-approvals, figuring out what they qualify for. I think they're kind of reevaluating the real estate landscape, and they want to, maybe they've gotten their kind of gusto back to get out there and weather the abuse of being a buyer in this environment. And so what I would say is talk to your loan officer, update your pre-approval, get them your updated bank statements, pay stubs, W-2s, tax returns. Let them know if there's been any life changes. If you've changed jobs or you've taken on new debt or anything like that.
Right.
Just have a frank conversation. Interest rates are different than they were a couple of months ago, and some prices have come down, right?
Yeah.
So there's some opportunity out there, I think, and so I would just recommend have really frank, open, honest conversations with both your loan officer and your real estate agent, and go out there and take some chances.
Yeah, and now that we're in January, people are getting their income statements back from 2022, and some people had a banner year last year.
Some people did.
So you might actually qualify for more than you think you can.
Or people started businesses during 2020, right? A lot of people got laid off from their jobs, or they couldn't do what they were doing, so they started a business in 2020. So we're coming up on the 2-year mark for those businesses for us to be able to consider that income as qualifying and eligible.
There you go.
Yeah.
It's like anybody who went into the real estate industry 2 years ago like we did. Now it's like, hey, we've been doing it for 2 years.
Yeah, you're about there. You're about there. Exactly.
So give us some information about how to get a hold of you.
Yeah, so the best way to get a hold of me is my cell phone, and that's 808-333-6790. My email address is tgreen, so tgreen, just like the color, at vipmtginc.com.
Okay.
Let's see.
Website? No?
You can just Google me, Travis Green, loan officer.
And you guys, this guy, we had like this 3-hour conversation around finances. Genius.
No,
really good guy. And he's very, very full of aloha and totally willing to help you. So reach out. I'll put those information points down below in the comment section too. And guys, seriously, he can even just help you brainstorm to see if it really is going to work for them to move to Hawaii and buy a house, right?
Yeah. Or if you don't know where you are, you need to have that conversation. The worst part about not knowing where you are is not knowing where you are. Right.
And then people get scared.
Yeah, give me a call and we can at least figure out where you are. And if it's not there yet, if you're not ready yet, we can talk about things that you can do to get on the path to buy.
Perfect. Okay. And with that, we say aloha.